Welcome back to Explain the Charts, everyone. Today, July 18th, 2025, we're diving deep into the performance of the S&P 500, specifically focusing on the SPY ETF, as the market navigates a complex mix of economic signals and corporate earnings. Recent headlines from CNBC and Yahoo Finance confirm that SPY, along with the Nasdaq, has been hovering near recent record highs, though it's seen some trimming of gains today. Just minutes ago, news broke of the Dow falling by 200 points, partly due to reports that former President Trump is pushing for at least a 15% tariff on EU imports. This potential trade policy shift introduces significant uncertainty, especially for global supply chains and multinational corporations within the S&P 500, as investors try to weigh its potential economic impact. This creates a push-pull dynamic where geopolitical tensions clash with underlying economic optimism. Despite this, the broader market has been buoyant, fueled by signs of economic strength and ongoing corporate earnings reports that have generally met or exceeded expectations. While some key companies like Netflix and Amex initially dropped despite strong earnings, the overall market sentiment points to underlying resilience in the face of various headwinds. Adding to the market-specific dynamics for SPY, the trade desk is actually set to join the S&P 500 today, which could provide a slight, technical boost to the index as passive funds adjust their holdings. Such structural adjustments can sometimes provide short-term volatility or support. However, a significant and highly influential driver of current bullish sentiment comes directly from Goldman Sachs research, which, in their widely followed July 7th report, notably raised its S&P 500 projections significantly. They now forecast SPY to rally a robust 6% to 6,600 in the next 6 months and an impressive 11% to 6,900 in the next 12 months, signaling strong conviction. This optimistic outlook is primarily attributed to their economists' projections of earlier and deeper interest rate cuts from the Federal Reserve, a move anticipated to lower bond yields and further boost equity valuations. Goldman Sachs explicitly states that every 50 basis point decline in real bond yields is associated with a roughly 3% increase in the S&P 500's forward price-to-earnings ratio, underpinning their valuation adjustment. Furthermore, they've maintained a robust 7% earnings per share growth projection for S&P 500 companies in both 2025 and 2026, which speaks volumes about the health of corporate fundamentals. Despite a sharp 25% rally since April 2024 and recent concerns about narrowing market breadth, Goldman suggests that resilient earnings, anticipated rate cuts, and neutral investor positioning could broaden the rally beyond just a few mega-cap stocks. Historically, the S&P 500 has demonstrated a median 7% rise in the 4 instances over the last 40 years where the Fed cut rates and the economy continued to grow, lending historical context to their projections. Crucially, they highlight that a catch-down scenario, leading to a significant market decline, would primarily occur if the corporate earnings outlook, particularly for the largest stocks, were to significantly worsen. Now, let's transition to the charts to see how these macroeconomic factors and today's news events are precisely reflected in SPY's recent and historical price action. Starting with the one-day chart, we get a clear macro view of SPY's performance over the past year and a half. Since March 2024, SPY has been in a very strong bullish trend, marked by consistent higher highs and higher lows. Notice the significant dip we saw in April 2025, where price dropped sharply from around 565 down to the 505 level. This level, previously a resistance point, effectively acted as a major support, confirming its importance as a robust demand zone. The swift and powerful recovery from 505 showcases strong buying interest and bullish conviction, quickly reclaiming all of the lost ground. This April pullback could have been a healthy correction, shaking out weaker hands before initiating the next powerful leg up, aligning with Goldman Sachs' mention of a narrow breadth potentially leading to a catch-up by lagging stocks. Following that impressive recovery, SPY has resumed its relentless climb, pushing into new all-time high territory in June and July 2025. The previous resistance around the 615 to 620 mark, established in late June, has now been convincingly broken and is likely to act as a new, solid support level. The sheer force of this upward move suggests that the underlying market strength, bolstered by growing rate cut expectations, is currently overpowering immediate negative news like the recent tariff talks. Volume analysis on the daily chart shows some notable spikes during significant price movements, for instance, high volume during the sharp April 2025 dip and its subsequent recovery, which indicates very active participation from both buyers and sellers. Overall, the daily chart paints a robust picture of sustained bullish momentum, but we should always be mindful of the potential for profit-taking at these significantly elevated levels. Zooming into the 1-hour chart, specifically looking at the price action since late June 2025, we can observe the more immediate trends and granular minor reversals. The consistent upward movement is clearly evident, with short and sharp minor pullbacks that are almost immediately bought up, indicating very strong underlying demand. Notice the impressive rally around early July, which rapidly pushed SPY higher, followed by a brief but well-defined consolidation phase. This consolidation often acts as a critical base for the next impulsive leg up, and SPY successfully broke out from it with conviction. Key intraday support levels have visibly formed around the 617 to 618 area, and then later around the 620 to 622 region, confirming active support zones. These levels effectively acted as solid floors during short-term dips, consistently allowing buyers to step in and push the price higher. The prevalence of green-bodied candlesticks shows more closing prices consistently higher than opening prices within each hour, which is a clear and strong sign of persistent bullish control. While we're trading at unprecedented record highs, the 1-hour chart suggests a controlled and measured ascent, rather than an overheated parabolic rally, which could imply a degree of sustainability in the short term. Now let's get granular and examine the 15-minute chart for the last few days, offering crucial insights into very recent price behavior and potential immediate entry or exit points. If we focus on the action from July 15th to the close of July 17th, we can clearly see how swiftly SPY responded to various market sentiments and catalysts. On July 15th, there was a noticeable intraday dip from highs around 627.75 down to 622.06, only to recover remarkably quickly by the end of the trading day, showcasing resilience. This rapid intraday volatility could be directly linked to the market reacting to transient news that causes immediate, but perhaps not sustained fear, like the earlier mention of the Dow slipping. Yesterday, July 17th, SPY opened around 624.4, and throughout the trading day, we witnessed a steady and strong climb, eventually reaching a new all-time high of 628.4048. The candlesticks in the very late trading hours of July 17th show a slight pullback from the absolute peak, closing at 628.04. This perfectly aligns with today's news headlines of SPY trimming some of its gains after hitting new record levels. This micro-level detail on the 15-minute chart suggests that while the overall trend remains strongly bullish, there's immediate overhead resistance and some profit-taking occurring at these fresh, elevated price points. For nimble short-term traders, watching these intraday peaks and troughs is absolutely crucial, as they precisely define immediate support and resistance zones, such as the 627.5 to 628.0 range, currently acting as immediate overhead resistance. A clear and decisive break above 628.40 would signal strong continuation, while a sharp rejection from this level could potentially mean a retest of 627 or even the 625 support levels. Recapping our comprehensive analysis, SPY is currently trading at unprecedented record highs, primarily fueled by strong expectations of continued Fed rate cuts and a generally robust corporate earnings outlook. Key long-term support for SPY stands firmly around the 500 to 505 level, which proved remarkably resilient during the sharp April 2025 correction, marking it as a critical and highly watched line in the sand for major pullbacks. Intermediate support can be readily found near 555 to 560, representing prior significant highs, and more recently, the 615 to 620 area has convincingly transitioned from a strong resistance zone to a reliable new support level. The immediate overhead resistance is at the freshly minted all-time high of approximately 628.40, a level that bulls will aim to break decisively. For a bullish short-term outlook to remain strong, we would ideally want to see SPY consolidate above 625 to 626, or more powerfully, achieve a decisive breakout above 628.40 with sustained high volume. This bullish continuation would significantly reinforce the likelihood of a continued push towards Goldman Sachs' ambitious 6-month target of 6,600, a prediction we currently assign a robust 65% likelihood, given the favorable Federal Reserve posture and the resilient earnings environment. However, a more cautious or bearish scenario could rapidly emerge if SPY fails to decisively hold above the 625 level, potentially leading to a deeper pullback towards 615 to 620, especially if unexpected significant negative news, such as a severe escalation in trade tariffs or widespread weaker-than-expected corporate earnings, gains traction. We assign this potential bearish scenario a 35% likelihood, particularly if the market's currently narrow breadth were to lead to a more widespread catch-down effect across the index constituents. When deciding when and at what price to trade SPY, always pay close attention to volume during any significant breakouts or breakdowns. High volume consistently indicates stronger conviction behind the price movement. Additionally, closely monitor the broader market breadth. If more stocks beyond just the megacaps start actively participating in the rally, it signals a healthier, more sustainable uptrend for the entire index. Finally, keep a vigilant eye on all upcoming Federal Reserve statements regarding future interest rate policy and the next wave of major corporate earnings reports, as these will undoubtedly serve as crucial catalysts for SPY's next significant direction. These combined fundamental and technical factors will ultimately dictate whether SPY extends its current parabolic record run or faces a more substantial and necessary correction in the near future. Remember, always conduct your own due diligence, manage your risk carefully, and align your trading decisions with your personal time horizon and risk tolerance. Thank you for watching Explain the Charts. Don't forget to like, subscribe, and hit the notification bell for more in-depth market analysis and chart breakdowns.